As many of you know, we had a very successful executive panel at the spring meeting of the IMF and the World Bank on climate change and financial stability, a unique pairing of two public policy preoccupations. Many of you who attended and others wanted to learn more. So now we're pleased to present this timely discussion on green finance, which is critical to fund the transition to a clean economy. This is not an abstract topic or one embraced only by environmentalists. The G20 recently acknowledged its importance in its communiqué from Hangzhou in China, and we have posted a copy of it on our website and encourage you to please read it. While new green financial instruments and infrastructure investment opportunities capture the attention of the private sector, NGOs, and others, supervisors and regulators have a critical role to play in ensuring proper oversight. On the one hand, they must be positive actors supporting clean investments in its current fledgling state. On the other hand, they must be vigilant against potential abuses by market participants as these investments gain size and momentum. Therefore, the challenge before this distinguished panel is to examine how supervisors and regulators can support the transition to a greener economy. Countries are increasingly aware that their financial systems can and must play a pivotal role in combating climate change. But they're also beginning to recognize that their financial systems must be made resilient against the looming effects of climate change on our economies. We have assembled a distinguished, knowledgeable, and experienced panel who will bring a diversity of perspective to this conversation. At this point, I'd just like to single out one of them. You have the bios of all of them, and I encourage you to read them. I think we emailed them to you. Mr. Aditya Narain, sitting right to my left. He's a member of the Toronto Centre's Board of Directors, a deputy director at the IMF's MCM and in charge of their technical training, and has led many FSAP missions, for example, US and Canada recently, plus Malaysia, and he hails from the Reserve Bank of India. So we're very happy to have him, and we pretty much owe the session to him. This discussion is important to us because it advances Toronto Centre's mission to promote change that will lead to sound, stable, and inclusive financial systems that, in turn, foster sustainable economic growth and poverty reduction. At this point, I would like to acknowledge the strong support we receive from the Government of Canada through Global Affairs Canada, the IMF, World Bank, and the Swedish SIDA. Also thank our partners for this event, the UNEP. So just wanted to introduce our opening speaker. It's my privilege to introduce Deputy Minister Peter Beam, who will deliver opening remarks on behalf of Government of Canada. He's a senior public servant with a distinguished career. Mr. Beam has served as Canada's Deputy Minister of International Development since March 2016. In addition to his departmental responsibilities, in his current role, Mr. Beam serves as the personal representative of Prime Minister Justin Trudeau, anyone heard of him, to the G7 Leaders Summits, as well as the Nuclear Security Summit. He has previously served as Canada's ambassador to Germany and to the Organization of American States, and has served in Canadian embassies in the US, Cuba, and Costa Rica. He has received the Canadian Foreign Service Officer Award for his contribution to advancing peace in Central America, and was the recipient of the Public Service of Canada Outstanding Achievement Award. Mr. Beam holds a PhD in history from the University of Edinburgh, and an MA from the Norman Paterson School of International Affairs at Carleton University in Ottawa. Please join me in giving him a very warm welcome.
Bonjour à tous et à toutes. Good morning, everyone. Honored panelists, a lot of expertise sitting here. I know that already. Guests and of course our session moderator Aditya Narain. It is a pleasure for me to provide some opening remarks ahead of this discussion. I know it will be a very informed discussion, and I appreciate the fact that there are so many here and some of you are standing. The challenge of building green finance to promote sustainable and inclusive economic growth. We are grappling with this in governments all over the world. Our policy people are in discussions, and of course we are making recommendations to our political masters all the time on this, and leaders are talking about it as well. I think it's fair to say that climate change has emerged as one of the defining challenges of our time. The climate change deniers, I think, are increasingly a minority. And we know that climate change touches areas that affect all citizens, health, agriculture, jobs, businesses, energy and infrastructure, just naming a few. All citizens, all countries, all governments are impacted, and developing countries, particularly the poorest and the most vulnerable, are the hardest hit, and many have limited capacity to prevent or to cope with its consequences. I think we're just seeing the impact of Hurricane Matthew on Haiti. Haiti is a country, just when you think it's coming on to track and elections are going to take place and we can reshape our development focus, something comes out of nowhere and pulverizes it. So there are consequences everywhere. As my boss, Mary-Claude Bibeau, has said, our Minister of International Development, climate change threatens water access, health, security of millions of people, and particularly women and girls, the most vulnerable. But confronting climate change and its effects, while also encouraging inclusive economic development and fighting poverty, is a complex global challenge. It requires global cooperation. It has been a subject of discussion in the G20, as many of you know, and certainly at the Isushima summit in Japan recently on the G7 side as well. But we have the good fortune of having achieved global agreement in three significant areas. First, we have the SDGs, the Sustainable Development Goals, also known as the 2030 Agenda. The goals aim to end poverty. They are far-reaching and include targets related to environmental sustainability and green growth. But most importantly, they are universal. So that means that developed countries like my own also have an obligation to implement the SDGs. And this is something that's very new. And if we don't succeed in doing that at a domestic level, then how can we be credible internationally in terms of when we reach out with our own development assistance? Second, the United Nations Climate Change Conference in Paris, also known as COP21, the past year, leaders agreed on the need for a new, or at least a significantly improved model of economic growth, environmental management, and poverty reduction. And of course, today is the big event in New York. We have had a debate in our House of Commons. The Commons passed the treaty with a very strong majority, and our instrument of ratification has been deposited. And I think with the addition of some of the large emitters, India, for example, that is what made that 55% threshold possible, and not without a lot of global leadership, particularly from President Barack Obama. Third, there is global agreement that we need to mobilize private capital to achieve development goals. Development assistance alone, using the taxpayer's dollar in our case, is not going to suffice. So we're looking at new and interesting ways of leveraging capital, either through development finance initiatives, looking at pension funds, sovereign loans. Everything is really on the table. And of course, there are a lot of actors who are non-state actors who have come into the picture, and it might be useful to talk about them. So, what is Canada doing? Our international assistance helps developing countries to achieve more sustainable and inclusive economic growth and to address climate change. And we see addressing green economic growth and climate change as essential to poverty reduction and achieving the SDGs. So all of this is going on with the 2030 Agenda and of course, the results of COP21 as we look ahead to COP22 in Morocco coming soon. We in Canada have embarked on an international assistance review. This was an early statement by the government, and we're in the process of sorting all of that now after we've received literally thousands of submissions from all over the world, as not only what we should be doing, but how we can do it better. So it's a very open process, but I dare say that climate change financing, and looking at climate change in new and innovative ways is going to be one of the central pillars of that. At COP21, we tried to assume a bit of a leadership role to promote action towards a low emission and climate resilient global economy, and we committed there to, the Prime Minister committed to $2.65 billion between now and 2020 to support climate change action in developing countries. And our goal is to achieve broad-based economic growth while reducing pollution and greenhouse gas emissions, minimizing waste, and improving efficiency in the use of natural resources. To achieve this goal, and working with a wide range of we are working with a wide range of partners, including the international financial institutions and the private sector. There's a lot that the regional development banks can do, for example. So as the challenges are out there, I think we realize, and other major donor countries realize, that we have to adapt how we address these things. I was recently in Abu Dhabi at the Tidewater Conference. This is something that started in the U.S. It's for heads of development agencies and ministers, and we had a long discussion about looking at new and innovative ways of tapping into financing and taking the issue much further. Just a few points more specifically on green finance, and I acknowledge I'm not an expert in this area. You have the experts sitting here, but just a few thoughts. The topic emerged as a major discussion point at the recent G20 summit in Hangzhou in China, and the communique there recognized the importance of scaling up green finance, as well as endorsing the Green Finance Study Group synthesis report, which of course is the basis for the executive panel's discussion today. Still, I think we in Canada and other G20 members recognize that green finance faces a number of challenges, including lack of clarity in definitions of green. Everything's green, but what really is it? We use green the way we might use red or black in other instances. So maybe the term is a bit overused, but I think we would have to look at how you measure green and be rigorous about that. So there's a definitional issue there. And then, of course, there are the difficulties in developing the right domestic policies to address these global risks. And in some countries, of course, you're dealing with federations. And in my country, we have, of course, a federal government, but under the Canadian Constitution, the natural resources belong to the provinces. So in some countries, you deal with subnational entities as well in terms of moving forward on policy. I would also submit, and I stand to be corrected on this, that there's an inadequate analytical capacity out there in terms of looking at this new area. So is this something else that we can push into the direction of the OECD or not? How do we provide the analysis? The G20 also called for creative solutions to be developed in cooperation with the private sector. I would submit that almost every G20 country has a different idea as to how that should take place. So I think that's something to think about. And financial markets have to play a role, given the scale of investment needed to transition to a green, sustainable economy. So green finance policies must, in the end, maximize funds available for this transition. And of course, we can't forget that the investors are going to want to be properly protected as well. Regulators around the world will need to understand the potential risks to financial stability from a failure to address climate change or a sudden collapse in the value of fossil fuel assets. Leading financial institutions, such as the Financial Stability Board, are examining how banks, insurers, and pension funds would cope if policies designed to reduce carbon dioxide emissions led to a sharp drop in the share price, for example, of oil, gas, and coal companies. And they're also looking at new rules to promote transparency on climate risk exposures and conducting stress tests based on different climate scenarios. So to address these risks, I would say that supervisors and regulators must have the skills, the judgment, the wherewithal to ensure that climate risk is properly accounted for in the assessment of financial institutions and financial products, in order to protect consumers and also the wider macro economy. So today's panel will look at the implications for financial sector regulators and supervisors who play a key role in maintaining financial stability and inclusion, essential pillars of green economic development. Let me say that as a key sponsor, the Government of Canada is very pleased to have been a strong supporter of the work of the Toronto Centre in training financial system regulators around the world since it was created in 1998. And over 18 years, the Toronto Centre has trained more than 10,000 regulators and supervisors in more than 190 countries in the key areas of banking, insurance, pensions, securities, microfinance, and microinsurance supervision. So on behalf of my government, I thank you all for attending. I wish you continued progress in your respective efforts to promote green, inclusive economic growth. Thank you very much.
Thank you, Minister. A quick announcement. I don't want to create a riot, but there is one chair here. Okay. All right. Minister, I'd like to thank you at least 4 times for what you've just said. First, of course, for laying out a very comprehensive assessment of the issues, and we do hope that the panel will provide a lot of insight into the issues that you've raised. And the other 3 things I'd like to thank you for is, first, as a private citizen of this planet, for all the efforts that the Government of Canada is making to make the planet a much better place to live in. The third is I'd like to thank you is for the, of course, you mentioned your support for the Toronto Centre, and as a member of the board of the Toronto Centres, I'd like to thank you for that. But even more than that, I'd like to thank you as an IMF staff member for the work that for the Government of Canada, for the funding that they provide to us, for the technical assistance that the IMF does in the area of monetary and capital markets. With that, I think I'd like to move to the issues for today. I see a lot of people I know in the audience, and I recognize 2 types at least. One, like my panelists who are experts on the subject. The other, like me, who want to know a lot more about the subject. So in our interventions, I would suggest that we aim to address both the audiences in the room. For instance, when we discuss green finance, the issue comes up often, and this is not just green finance, it's all the other feel-good terms that we hear: green finance, responsible finance, sustainable finance, environmentally sustainable finance, climate finance. What is it that we talk about? They're all absolutely, in my view, eminently desirable objectives. But for today's discussion, we will focus on green finance, and let's take the definition which the G20 Synthesis Group itself has promoted, that is the promotion of investments in projects that have environmental benefits. And here we mean projects, as the Minister mentioned, which may either address issues of air, water, land pollution, or which may combat or reduce greenhouse emissions, or which may create better infrastructure investments, or make for more efficient use of natural resources. So that's what we will refer to when we discuss green finance today. The Minister also mentioned the G20 Synthesis report, which is going to be one of the main topics of our discussion for today. And let me start first with Michael. Michael has been the co-chair of the study group. Michael brings a lot of very different expertise to the discussion. He's been in the private sector, a banker, if I recall correctly. He is now with the Prudential Regulatory Authority and therefore wears a regulatory hat as well. He's with the Bank of England advising on those issues, so I would label him as a central banker too. And now with all of these hats, I come to you with, I'm going to ask you about your experience in the negotiations or the discussions, using those as a background for the G20 Synthesis Group. If it's such a good thing, what and why are there so many barriers to the promotion of green finance? So what are the barriers, and what are the options that you finally came out with it to address some of these barriers?
Well, first of all, I'd like to again thank the Toronto Centre for their gracious invitation in putting this group together. The Minister, as well as UNEP, again, one of the supporters. Being able to further this discussion is very important. And I would also say some of the people in this room are extraordinary. Some of them are members of our study group. So they're extraordinarily switched on to all these items. So I think they could benefit all of us by contributing as well at some point. But to answer your question, the G20 study group was formed this year as part of the Chinese presidency. It was the sole original or new piece of work the Chinese put forward, and it just very clearly demonstrated the amount of importance that they and the G20 put in the in green financing. And the goal of the study group is to mobilize private sector funds to actually address these green initiatives. And as the minister pointed out, private sector funds are absolutely essential because the public sector can't do it on their own. What we tried to do this year is look across the board, both into the banking, institutional investors, products such as green bonds, risk analysis. Again, as the minister brought up, analytical capacity is a big issue. And then how do you keep track of all this and what you're doing? So we came up with a variety of both barriers as well as options to try to address some of these. Now, I won't go into all of them in detail, but some of them are quite important and they're big issues. Obviously, green bonds, everyone's heard everyone talk about those quite a bit, but how do you actually mainstream them? Because how do you mobilize the amount of money that we need? I think the New Climate Economy just had their report, their latest report come out yesterday, and they were using somewhere around 60 to 70 trillion, actually maybe closer to 90 between now and 2030. That's a tremendous amount of money under anyone's watch. And so how do you mobilize that? And you can't do it just off of not only public balance sheets, but you can't do it off of just bank balance sheets. And that's why green bonds are important to the equation. Right now, there's roughly 100 trillion of institutional money available, and less than 1% of that goes towards anything green. So consequently, to tap into that, and that's the goal of the study group, is how do we make investment in green opportunities attractive to that institutional investment base? And that gets to your question, what are some of the challenges we've met? Some of them relate around asymmetric information, that it's not out there. Other is things like banks have maturity mismatches. And I know these sound very boring and technical, but they're very important issues. And until you can start moving projects and money off of one balance sheet into a bond or a public entity or to exchange, so it can tap into the institutional investment market, you're really kind of lost. So some of the other barriers that we found was capacity building. All of you are terribly aware of a lot of this because we've been talking about quite a bit, but just finding adequate capacity in nations, and it's not just the emerging markets, but it's everywhere. It's in the developed markets. People will ask you, well, what is a green bond? What makes it different? Why are we financing this? How come the yields aren't commensurate with it? What makes it different? And so all of these different areas were huge challenges, but we think demonstrations and events like this, and then wider ones where it goes out to the general public, where you can start having open discussions both within the industry, the public, and within the public sector, are absolutely essential. And I think the Bank of England and the PRA have been, very, very much out in front of this as a group. The Chinese have been extraordinary in their latest issuance of their 35 principles that were on the 31st of August. And a lot of the other countries here are finally now starting to engage in it. We're having discussions. This was limited, really, even 2-3 years ago. We couldn't have this discussion, but most of us in the room now can talk about the basics around why disclosure is important, because right now lack of disclosure is a very big deal, and the FSB is doing extraordinary work putting together the task force, because you can't deal with analytical capacity if you don't have data, and you can't have data if it isn't disclosed. So the barriers are out there, but they're constructs, and they're things that can be addressed, and they are things that can advance green financing forward.
Thanks, Michael. Let me move now to page 9. Here is very well known page of green finance that I had mentioned, or not green finance, on responsible financing that I had mentioned. Now he heads the climate finance group in the IFC. He was earlier, has done a lot of work on access to finance and financial inclusion as well. So Per has also been involved with the G20 study group. But there's another role that you play, and that is as the coordinator of the Sustainable Banking Network. And one of the options coming out of the Green Finance, the G20 study group, and which you mentioned, was this about more scaling up the capacity building and the capacity learning networks. And the Sustainable Banking Network is probably one example of this. Can you tell us a bit more about how this fits into the bigger picture and what more should be done in this regard?
Thank you, Aditya. Let me just start off by just setting briefly the frame for our engagement with the Sustainable Banking Network, which is a network of both regulators and associations, banking associations in particular, that was started in 2012 with the support from 10 countries, including China, Vietnam, Brazil, Peru, Bangladesh, and a few others, and has since grown into a network of 26 countries representing both regulators and banking associations who are very much committed to developing sustainable finance standards. How did we get there? IFC has a long track record of working through financial institutions and financial markets to drive the development agenda of our institution, whether this is financing small and medium-sized enterprises, affordable housing finance, and also green finance. And IFC got into this business 20 years ago when we started our first green finance program in Eastern Europe, and we just took a survey at the beginning of the year of our over 750 financial intermediaries. And even surprising to us, over 2/3 of our clients said that they're already active in green finance, right? I mean, we're talking about mobilizing the financial sector for green finance, and that was even surprising to us. And these institutions account for 1/4 of all banking assets in emerging markets, excluding the BRIC countries. So this is not a small, this is a significant share of banks in emerging markets and financing that goes towards the green economy. Now, they face a number of challenges, right? I'm not saying that they're already there in terms of seizing the opportunity. And so one of the key issues in order for a financial institution to be credible in this space is to have solid environmental and social risk management systems. There's been a lot of criticism about this in the financial institution space, and something that we take very seriously. And so we launched the Equator Principles together with a number of banks, building on IFC's performance standards that have really committed many financial institutions to this space. But what we realized was that this is not something that financial institutions can only take on their own, but there's an industry and market level intervention that is necessary, and that really brought us to the Sustainable Banking Network. Because that really looks at two aspects that regulators, but also associations and the industry can take on. One is the risk side, which is absolutely critical to get this right. We heard a little bit about the FSB task force on climate-related financial disclosures and the respective risks that go into this. And then the other side is the opportunity side, right? So how do we finance the green economy, and how do banks and capital markets really seize that opportunity? And clearly, we see that the green bonds market that we've talked about is clearly one of the new and exciting opportunities that go beyond traditional ways of financing it, and we'll probably talk a little bit more about it, what goes into this. But our ambition is, and we greatly appreciate the work that the G20 and UNEP inquiry has done on this with the endorsement to scale up peer learning platforms that are really important to share experience at the country level. Our plan is to scale that network that now includes 26 countries to 50 countries by 2020. And one of the key areas to focus on is really the development and passing and putting in place both voluntary and regulatory standards that can help drive the financing for the green economy. Today, we have 12 countries that have passed both voluntary and regulatory standards. I think China's very much advanced in the space, having passed the green credit policy already in 2007, and then green credit policy guidelines subsequently. And we see a number of countries that are very, very interested in this, both on the banking side as well as at the capital market side. And the Sustainable Banking Networks seeks to provide that platform to help grow that experience, share it with others, and really disseminate it in a very practical way on the ground.
Thanks, Per. I'm moving now to Bill Cohen, an old friend and colleague who's played a very critical role in the development of the post-crisis regulatory reform agenda in his role as the Secretary General of the Basel Committee. The work he does is always in the news. I think the discussions on Basel III for the last 2 days have also been extremely, have kept you very busy. But the question for you, Bill, here is this. We are discussing the implications of green finance, on the broader financial stability framework as well. What does Basel have to do with this? So what is the significance of all these innovations that we are talking about on the broad prudential framework, and what is the role that Basel has or might want to have or will play in this effort?
Thank you, Aditya. Good morning, everyone. Let me start by thanking the Toronto Centre and Minister Beam for his comments. This really is a pleasure. Everyone says, "Oh, it's a pleasure to be here." This is a pleasure for me to be here. As Aditya mentioned, I spend most of my waking and some of my sleeping moments working on something that is very near term. We're trying to finalize regulatory reform in the next couple of months, and so this has consumed my life. But I'm a father of three. I've got three daughters. We live in the beautiful country of Switzerland, and so this is an opportunity to step back, think of something long-term, something impactful, something that's really important over a long period of time. So I really do appreciate the opportunity to talk to you about this and to hear your views about the topic. And Aditya asks an excellent question. So what's the role of the Basel Committee? The Basel Committee sets global standards for bank regulation. So what's the role for bank regulation? I'm reminded of. I'll draw a parallel that may not be so obvious at first, but I hope to demonstrate that there is a parallel here. 1 week ago, the Basel Committee organized a meeting, as we do every year, on financial inclusion. Queen Maxima of Holland, the United Nations Special Envoy for Financial Inclusion, hosts the meeting or chairs the meeting. And the parallel is this. Because something is socially beneficial, I mean, there are tremendous social benefits to financial inclusion, isn't necessarily something that the Basel Committee needs to regulate. When for a lot of regulators, maybe myself included, when you're a hammer, all the world is a nail, and you think you have to regulate everything. So let's say right up front, I'm not sure this is something that needs to be regulated, but we also have we have certain exposure, we have certain cachet, and so what is the role for global regulators to play in this? And the first thing that comes to mind is got to demonstrate that there's a prudential safety and soundness issue at play here. We've got to demonstrate that there's a financial stability aspect, and that's hard to do, given the time frame. So we're talking about climate change over maybe a generation, probably far less. We think in terms. Bank regulators think in terms of. Well, there's the monetary policy cycle, 2 to 3 years generally. Let's hope anyway, 2 to 3 years. There's the financial cycle, 15 to 20 years. So if we're thinking about climate change over a much more extended period, well, the danger, of course, is that we're running out of time. We're not doing something now that we could otherwise, we could very usefully play a role in this. On this topic. A few people, my co-panelists, my fellow panelists, have already mentioned the importance of data, and the FSB's work, the excellent work. I see Rupert Thorne from the FSB is here with us talking, and the excellent work that the FSB has initiated on disclosure. I think that's really an excellent starting point. At the moment, it's I guess the best way to think about disclosure is quantitative. So for banks to talk about their risk management assessment when it comes to green finance, what are the risks? And that's really from a global regulatory perspective. That's really that's what gets people's attention. Is that there's a clear link between risk, prudential safety and soundness, financial stability risks, and that has to be demonstrated to engage bank regulators on the topic. So I do think there's a risk here. I do think that the direction when it comes to disclosure, I think it's going in a very good direction. So I would say that when it comes to the Basel Committee, I don't think there is a role at the moment to regulate this. The bankers here will be glad to hear that. But I do think there is a role that, given the access, the visibility the Basel Committee has and the FSB, I do think we will continue to be involved in promoting the disclosure of the risks associated with green finance. I like to use the example of people ask me, well, what are some of the risks? What could be a risk? And I think of the very simple example of Volkswagen and Tesla. So two car companies, but how does environmental risk play a role here? Volkswagen, of course, with the emissions scandal. If Volkswagen is a company that borrows directly from banks, well, there's a risk there because of liability risk, and so that's one set of risks. Another risk, though, from the Tesla perspective, is a sustainable business model and long term. What's the role of bank finance when it comes to a company like Tesla? So two car companies, both two very different types of risks, but be very interesting, very insightful, I think, if there were disclosure around how banks think about environmental risk, and I think that's an excellent starting point. So, as I said, the Basel Committee will continue to be a strong proponent of risk when it comes to green finance.
Thanks, Bill. And at this point of time, I'd like to welcome our fourth panelist who's joined us. Ashley, welcome. We've just had a little bit of a discussion on what some of the barriers are early on some of the barriers to green finance, to scaling up the efforts in this area. And if you really want to know what the problems are, you've got to follow the money. So now we have the money on the table. Ashley represents BlackRock, which manages roughly between $4 and $5 trillion in assets. And as an investor, as a potential investor in green finance, in initiatives related to green finance, the question I would pose to you is, what do you think are the barriers that are preventing the growth or the scaling of this market, and what instruments and facilities should be provided either by public policy or by the markets to be able to support this?
Great. Well, thank you, and apologies for being late. So I am a very lowly portfolio manager at BlackRock, which means that I'm sort of charged with taking some of the walk and talk and seeing if I can turn it into walk on a day-to-day basis, and really wrestle with the concepts of, if we're going to look at water scarcity issues, what are the actual tools that we have to look at those on a credit portfolio? If I have a portfolio of 500 securities, how do I think about aggregating climate risk across a big pool of assets? And so we've been working on the really tangible items that can help risk managers or portfolio managers take a look at some of these issues that we're discussing. So I'll say four things that I'd like to bring up. The first one is education. And so one of the things that I have definitely been involved in over the last couple of years is education on both sides of the environmental and finance communities. So for sure, from the finance perspective, learning about a lot of these environmental issues are new topics. There are new risks that your average portfolio manager has not really taken into account over past years. And there's an education process that is happening and needs to happen more. I think on the same side, when I speak to environmental ministers, there is an education process happening that is about financial markets and how they operate. So sometimes when we have these conversations about addressing green investment, there's an assumption that we can just decide to be green and then all of a sudden asset allocate into EM renewable infra. And the reality is that that's a challenge that asset owners are going to not just change their asset allocation mix because they want to be green. So we have to think about that that construct in the markets. If you think about BlackRock and our infrastructure business as it relates to our total assets under management, I think we have about $9 billion on our infrastructure business. That's compared to a $5 trillion asset management business. So it's a very small percentage of what we manage. And so we have to think about ways of making those green projects digestible, really, to these very maybe risk-averse or liquid pools of money that need QSIPs and ratings and daily liquidity and want to trade 5s10s and want to do dollar yen. And what are the instruments that we can use to help channel investment into those things? So on that note, I think that there are two ideas that are successful in that space. And the first is green bonds. And so green bonds have been a way to sort of transform the desire for an investor to want to allocate toward green projects, but maybe was unable to in the previous vehicles that were available to him or her previously. And so we've seen an enormous success in that space. We're looking at about $150 billion in a labeled green bond market right now. And I think the trends are very positive there. I think we're going to continue to see more interest in green bonds in terms of adding them to vanilla portfolios, more support from public bodies, hopefully, to help add standardization and boost support in that sector. And the other concept is to think about securitization structures, which I don't think we've really seen many successful ones come yet. There have been some small deals that have come out of supranationals that have had some maybe foundation or family office first loss support. But the reality is that when you think about infrastructure as an asset class, and then you think about EM infrastructure as an asset class, I mean, that's a very difficult asset class that is illiquid and has an enormous amount of credit risk to it. So what are the ways that we can transform that and make it a little bit, again, more digestible to investors that they can add that to their mix? And securitization structures and first loss guarantees are ways that we can think about that. And so I know that there have been commitments by some public bodies to help support some of these first loss structures. We are working on these. We do see interest in them. We do think they are viable. It really takes getting the combination of the EM experts at your firm, the infrastructure experts at your firm, the securitization experts at your firm to sort of come together and be imaginative and think about, let's create a new asset class here. Or maybe we can have, not highly rated, but at least investment grade ways of investing into the sector. So the third thing I'll say is that I feel like in this space, one of the things I noticed over the last couple of years is that we tend to get bored very easily with some of these new toys that we have in terms of looking at climate risk. So, and I think that there's this idea that there's going to be some deus ex machina that comes down and it's like the silver bullet of the new financial engineering that's going to change everything, and let's search for that now. And one of the examples I'll use for that is carbon footprinting. And so we do now have good Scope 1 and Scope 2 either disclosure or estimates on most of the corporate bond universe. We either get it directly from them or we get good estimates from carbon providers. And this is a way that is something that's quantitative, that we can now pipe all of that data into our systems to think about evaluating portfolios on a carbon footprint, carbon intensity basis. And at BlackRock, when you have a portfolio, again, of 500 securities and you want to think about what's the carbon intensity of my portfolio, it's very helpful if you can put a score on it. I know it's not the perfect thing, and now that we have all this data on Scope 1 and Scope 2 emissions, there's this new, sort of theory going on that life cycle emissions are more important, and if you don't have Scope 3, then it's not helpful. But I would encourage us to sort of stick with what's working right now and where we do have data, and use these tools as just even a heat map of where risks might be in a portfolio. So that's the third thing, to sticking to what works. Green bonds is another example. We've seen enormous success in the green bond market. Issuers are finally coming around to the idea that they can issue these bonds. It's not much more work for them. And slowly, for us, investors are coming in and saying, we'd like to continue to add green bonds, or we'd like to add green bonds to our vanilla portfolios. And this is something, we've been talking about green bonds. I've been talking about green bonds for years now. And finally now I'm getting some traction. And so I would like to keep the discussion and just hammer on green bonds because it is working. I think there's an effort now to think about what are sustainability bonds, and let's do social bonds, and let's go in different directions and create something new. We're actually sticking to the green bond space and going deeper on it and thinking about impact reporting and regulatory help on these things, I think is really beneficial. The fourth thing I'll say is thinking about individual motivations in this. And one of the things I've noticed personally in this green finance adventure is that it's a new sector, and individual treasurers or investors are a little bit nervous about sticking their neck out and being the first to invest in something. What if you invest in a green bond portfolio and then something goes sideways and it turns out not to be green? You know, what's your liability on that? Are you going to get sued for that, for representing something's green? Do you have job risks on that? I mean, there's definitely sort of, you know, a couple groups that are going out there and putting their name out there and being public about their commitments, like CalPERS or Norse Bank or the AP funds. But others are sort of waiting to see how the market develops. Call us back when you have a track record. Call us back when this market is 300 billion, et cetera. And so I would encourage public bodies to think about ways that they can provide air cover for investors in the space by maybe providing seed capital for commingled funds or just being public about their own investments. There are a lot of very loud voices in the space about climate risk that perhaps in their own public pension funds or in their own sovereign wealth funds are really not acting. And so, you know, to have those great examples out there that we can learn from and use as air cover is really helpful.
Thank you, Ashley. I thought that's a very extremely useful intervention and probably provides us with some scope for further discussion. And let's pick up on one of the themes which you talked about, which you said we shouldn't get, you know, we get bored and with the new toys very soon. So let's not do that. And we'll continue to hammer on this point which you said about green bonds. So let me go to green bonds first, and maybe let me start with Per. What is the promise of the green bond markets, and what should be done to accelerate this?
Thank you, Aditya. So I share Ashley's passion as well as your view on the promise of the green bond market. As IFC, we have been one of the first issuers of green bonds ourselves when it was a very nascent little niche market for supranationals to issue in. But over the last 3 years, and I think particularly with ICMA taking on the establishment of green bond principles, we've seen really a pickup in the market where you have corporate issuers and financial institutions that have been now issuing green bonds. And now, as you mentioned, we're now at $150 billion. That's obviously still small compared to the $100 trillion in the capital debt markets, but it's clearly a start and it's growing very fast. What we also have seen is that, and that goes back to the point about the leadership at the national level, with countries like China taking this on, developing their own green bond principles, green bond catalog, and really encouraging this market segment, we've really seen a pickup there as well, which makes us believe that this is an opportunity that we need to take to more markets, in particular for us, with our mandate as IFC, more emerging and developing markets. So we've been working very closely with the Green Climate Fund along similar principles as Ashley pointed out about structuring a vehicle together with capacity building that brings in also the sustainable banking network to really increase the availability of supply of green bonds from emerging markets, as well as to help with regulations and crowding institutional investors in here. So this is now work under progress. We hope that now by the end of December we can announce that more formally. And of course, we continue to work with our client base in the space, right? I mean, so we're working with a lot of first-time issuers right now where we basically bring to bear IFC's footprint. We've worked with over 140 financial institutions in emerging markets on green financing, and they have now green assets. And so making them ready so that they can report on this, that they know kind of how the impact reporting in particular, which can sometimes be difficult, works well. Obviously working with the treasuries on second opinions and how do you get them ready to really go to that market.
Thank you. Michael, so continuing on this theme, and of course glad to hear your views, but also would like to know whether we should be getting bored of our old toys or we'll continue working with new ones.
Well, first of all, I'd like to really shout out what Ashley brought up. I think it's extraordinarily important, and it's an area where you can see great growth, and that's in the securitization market. Basically, being able to put covered and asset-based green bonds together will be extraordinarily important. Basically, being able to take off of, and this is both for both the emerging markets as well as for the developed markets, Again, I'll give an example in China because it was just announced recently. They're taking a large pool of onshore green bonds and loans off the Bank of China's balance, or on their Bank of China's balance sheet, going to take it, put it in a special purpose vehicle, and then list it on the London Stock Exchange. And that starts giving international investors an opportunity to see onshore emerging market green debt. Now, there's a wrap on it, so you, in many ways, you'll probably take the risk associated with the bank, but as this goes and performs well, again, to Ashley's point, maybe then it becomes a first loss of only 30% or 40%, and over time, as it demonstrates that it's working, that it's moving assets off, it's a very powerful thing. And that also does two things. One is it allows the bank, it frees up their balance sheets to do new loans, and for these green securitized bonds, and again, there was one done in Germany on commercial real estate. I think it's by Berliner Bank, but extraordinary. All the commercial mortgages were green. The funds from that were going to go then towards more green mortgages. So it's a self-fulfilling green cycle, and the Bank of China is going to do the same thing. So in terms of products, that I wouldn't call that new. It's basically rebranding an old product. So, and I think those old ones can be very well applied, and I think they're very good for both markets, and again, using first losses and guarantees on some of the other markets is a very good way of helping that as well.
Thanks, Michael. Not many people know that Bill is one of the experts in securitization in the Basel Committee, and he's been one of the people who've been working on the very complex formulations coming out on this. Following up on this, on the theme which was raised regarding these creation of these securitized products to be able to help promote the market, and the broader theme of regulatory incentives, do you think that there is scope in the framework, the regulatory framework, to create positive incentives for the promotion of products like these securitizations which were referred to? Directly, if I may ask you, would you argue for, would you agree to a lower risk weight for some of these categories? And I'm sorry to put you on the spot there.
No,
This is on record.
that's no, Aditya. That's an easy one. Unequivocal no. I don't think no. There is certainly scope for things that we can do on the regulatory side. I mentioned disclosure. I think at the moment that's probably the most we could do. But when it comes to providing incentive, I have to draw the distinction between like socially beneficial projects versus risk and financial stability. We've seen in the past. I worked for a bank in the 80s, into the 90s, and the whole concept of home ownership was viewed as a social benefit, and there were regulatory policies that encouraged lending. There was an element of that in the recent global financial crisis. I don't think regulatory policy is a good way to encourage social benefits or something that's deemed to be socially beneficial. Ashley and Michael both mentioned the role of first loss guarantees on securitization pieces. I think that's the best way to go. If you want to encourage something that is deemed to be socially beneficial, the best way to do it is through a direct subsidy, a government subsidy, not to do it indirectly through bank incentives. It doesn't work well. If you want to do it directly, and the best way to do that, I think, is through first loss or guarantees of securitization. It's a direct subsidy that comes, that's meant to encourage that, but not through regulation. It usually has unforeseen and unintended consequences.
Thank you, Bill. I would probably share your view on this topic as well, but let me move on to an issue which all of you raised, and that's the issue of disclosure. There was mention which was made of the FSB's work on disclosure and climate risk in firms. There was mention which was made even by the minister, and Ashley talked about making green projects more digestible, and one of the things you can do to make this more digestible, of course, is to provide good disclosure as well. So I'd like each of you to think about if these if there was a market improvement in the disclosure of climate risks in the disclosures of firms, and let's take a number, if 80% of the firms were able to disclose 80% of the climate risks which they carry embedded in their portfolios, do you think this would make a great difference to the market?
Will you start?
Yep.
All right, I'll address this one with my regulatory and central bank hat on. So basically, if we're able to get very good data, and Bill brought out the fact it's really what central banks focus on is financial stability and safety and sound. Well, again, the remit of the some are different, but the remit, at least of the Bank of England and many other central banks, is basically financial stability, safety and soundness of policyholders and depositors. So if you're able to get good data, that allows you then to start putting that into models and understanding where the risks might bite. And just like you would do with standard credit risk and market-based risk. So data starts giving you the opportunity to start stressing it. What if this? Here's a worst case, base case, scenarios. And then you can start making better decisions. And you can decide, well, maybe there is a financial stability issue involved in this, or maybe there is a safety and soundness issue. So I think what it does is the data is the first step in being able to analyze and determine what risks may or may not exist in what type of timelines, under what circumstances. So must point out that the Green Finance Study Group is in the finance track, which is the central bank and the financial ministries, and we're trying to, again, looking all this through the lens of how might it possibly affect these areas. That i.e., if you can have a steady transition or an orderly transition, that will hopefully then not have effects in the greater markets. So I think data is extraordinarily important, and what FSB and Rupert are doing are absolutely critical. No pressure, Rupert.
Thanks, Pep. Could you also provide your own response to this, and also link it to the issues of measurement that concern you a lot?
Yeah, I'm very passionate about the point of data, because I think we're currently flying literally blind, right? And that relates even to your question, to Bill, do we need regulatory incentives? No, I mean, if I just look at a study that was done here in the US, looking at 71,000 home loans, some of which were Energy Star certified, others which were not, and the mortgages that have been extended against them. There's surprising findings in here that those with Energy Star certification had a 31% lower default rate and a 20% lower prepayment rate, right? If that's the case, right, and one has to dig deeper into the analysis here, but that goes to the point of data. If banks have this data, right, and if this indeed holds true, and the researchers say this holds true at the same FICO levels, same income levels, same neighborhoods, same values of homes, then we don't need to ask the question about regulatory incentives, right? Because it will follow through in Basel 3, 4, wherever we will end up being by the time that happens, because it will directly translate into kind of capital charges that will be taken against it. Now, currently, I believe that with all of the big numbers that have been mentioned, right, in the trillions that need to be mobilized for green finance, today we really don't know how much is being financed, right? I mean, there's some estimates out there. I think OECD has done great work on this. We know it a little bit on the green bond space because it's a fairly limited universe to observe, but we don't know it about banks or financial intermediaries in emerging markets. And I think there's only 3 countries that I know of that are making an attempt to do that consistently. Again, I mentioned China before. China's probably the most consistent here because they ask their 21 largest banks, which account for 80% of banking assets, how much they're doing in green financing, right? So we have some data there. But I think we definitely need more to get an understanding as to which, are we moving into the right direction? Are we really mobilizing more? And I think that then ties also back to the question of risk, right? Because I personally see it not just for risk, right? I think it's a risk opportunity question because, coming back to the mortgage example, right? To my mind, there's an opportunity, right? I mean, the risk is,
I think useful linkage between disclosure and the fact that disclosure would lead to a better alignment of risk with the, let's say, for instance, the capital requirements automatically and may not need any incentives from Basel. And Ashley, would you want to comment on this?
Sure, I'll be like the presidential delegates and answer an old question. I have the microphone, but to the point about regulatory support, I do think there are examples where regulation can help. And I'll point to a couple things. The Department of California Insurance Commissioner came out recently and required that any insurance company doing business in the state of California had to publicly disclose and then divest of any investment that made more than 30% of its revenue in thermal coal. So that was an exercise that we took on at BlackRock to go through all those big portfolios and get rid of thermal coal holdings. And I think it was viewed as a financial risk, a stranded asset risk. And there was, a decent amount of political pushback on there. But there's an example right there where a regular came in and, got its,
Act together?
yeah, I just, force some sort of conformity on its sector. The other example I would use is that ECBC, European Covered Bond Council, came out a couple weeks ago and basically said that it is going to be looking at green covereds, so what they call them energy efficient covereds. But basically to make the argument, to your point, that perhaps energy efficient buildings actually have better credit worthiness than non-energy efficient buildings, and so therefore they might be able to argue for lower haircuts at banks on those. And then to the point about the social goods, I think, talking about housing is a really interesting example in the U.S. because we have these huge, institutions, these GSEs of Fannie and Freddie that were basically created to promote a social good, which was home ownership. And so you can look at, society today and think, if we really want to be imaginative about this, do we really want to continue to support, home ownership in the way that we have, or have we made it down that road? Do we have enough private markets to handle that? Should we retool and think about GSE support for green causes? And could there be some sort of tax benefit for that? So, in the U.S., home loan and farm credit debt is state and local tax exempt. Why couldn't we have an environmental GSE that is state and local tax exempt as well? And so then to your question about disclosure, I really feel like this is such a rabbit hole you can go down. And there's so many ways to think about it. And do you think about macroeconomic risk? And under the 6-degree scenario, labor productivity is X, and then we expect GDP to be Y, and then we're expecting emerging markets to suffer because, there will be physical impacts, to, very narrow things about thinking about company disclosure of R&D or asset location in terms of, flooding risk, things like that. So we throw around the word disclosure a lot. It means a lot of things to different people. There's even this new concept or new toy, I say, going around of thinking about aligning your portfolio to the 2-degree scenario. And, the way that the markets have sort of come to agreement on that is to think about the IEA 450 2-degree scenario and what the balance of technologies looks like in that one scenario that the IEA has played out, and that includes a certain amount of carbon capture and storage. And then let's take portfolios and align them to that. The problem with a lot of those transition scenarios is that you're assuming a certain amount of regulatory action, right? So you're just making a bet on what you think regulators are going to do to help us transition. And so, that's one of the things that's very hard to do, especially in the U.S. when you have very little clarity on what regulation is going to look like, depending on what the politics are. Are we going to get carbon taxes? You're kind of guessing a little bit there.
Let me just pick up on a point that my fellow panelists have brought up, and Ashley's right. Disclosure, what do you mean by disclosure? I think of it a little bit more broadly. Data, disclosure of banks is important, but I like the point Pierre mentioned about, if some of this finance, if you could demonstrate that there is a lower default risk or lower prepayment risk, those are the kinds of things, important inputs to the credit assessment process. And I'll appeal to Deitch's, his bearing. He's a former bank supervisor. I don't know if he'd ever mentioned that or if he's embarrassed of it. I'm not sure. But from a supervisory perspective, you look at how a bank makes loans, and if a bank can fully demonstrate that it was a well-founded decision based on good data, risk is good. We as regulators, we encourage risk as long as it's properly managed. And properly managed means there was a very thorough, a comprehensive risk assessment of the credit that was extended, and of course, as long as there's appropriate capital to back it up. Let's not overlook capital, but data, and this is a, from a bank perspective, this is a relatively new field, lending green finance, or banks' participation in green finance. And the more data that's available to substantiate banks' involvement in it, the better it is for the bank, of course, from a risk management perspective, but certainly from a regulatory supervisory perspective, the more comfort it gives supervisors.
Thanks, Bill. I think you make an excellent point here that it's very likely that good environmental decisions might just lead to lower financial risk on their own. And we don't know that, but we hope that there's a correlation like that which may exist, and probably we may learn later on. But it's now time for a few questions from the audience. Please feel free to ask any or all of the panelists. Yes?
Thank you, Mr. Chairman. First, I would like to thank Toronto Center for giving us this opportunity, and I thank all the panel for their good information. However, I have the impression that there is a real need for regulation, and the regulators should come in. I was expecting Basel Secretary General to say that we will look for regulating this. I am a central bank lawyer. I'm coming from Bahrain, and in GCC there, or in Bahrain there, we are really taking care of green finance. This is the policy for green finance of UAE. This is the policy of green finance Bahrain. And I mentioned here in my books what is happening with reference to green finance in Gulf countries. And since we believe that there is a real problem regarding the environment, then we have to take active step. Better today than tomorrow. We have to take very active step, and I believe it is time to be more, for the regulators, to be more active and supportive in this area. Thank you.
So, Bill, I think it's a question for you.
My background, I'm an American, but I come from Irish ancestry, and the Irish are known to answer a question with a question. So I'll put the, what do you think we ought to regulate? Are you talking about capital regulation or more supervisory, bank supervisory involvement? I'm not quite sure what we ought to be regulating.
For banking sector, I think we need a kind of regulation for the credit policy. And as we know, there is this equator principles and this, which has been going on since long time. So we need central banks to come in so as to put certain rules for credit policy with reference to preservation of obtaining green innovations in banking sector. Also, this goes for the securities markets with reference to green bonds, green sukuks. We have a lot of sukuks, which is Islamic bond, going there, and we need to also put some regulations with reference to this. This is what I mean.
Okay. Sure. Okay. Thank you for clarifying that. I was afraid you were, as Aditya alluded to earlier, I thought you were going to suggest we need some kind of special risk weightings for green credits. But you raise a very good point, and it reminds me of something we had done. We've had contact over the course of the last 3 years with the United Nations UNEP, United Nations Environmental Program. Yep. In collaboration with Cambridge. We've been meeting with them on a fairly regular basis, and they've asked us. One of the things that came out of those discussions is to survey each of the Basel Committee member organizations, and we had to see if there are specific provisions in local regulation when it comes to green finance or climate change, and we had done that about a year ago. 18 months ago. It was just a survey of Basel Committee organizations. There were roughly 50 organizations on the Basel Committee. So we asked each one, do you have special provisions when it comes to climate change and green finance? And the ones that come to mind, certainly Brazil, China, a few others, but clearly the minority. And the way we left off with the United Nations and the Cambridge folks was to follow up. That was the snapshot about a year and a half ago. There was relatively low involvement, low central bank supervisory authority intervention when it comes to this topic, and we had agreed to follow up at some point, some certain point in the future, most likely next year. But your point is well taken. I think if I could rephrase your point, I think the benefit of having some kind of central bank or supervisory authority involvement is to raise awareness, and that's something, and I fully agree, that's something we can do. Whether or not we go down the road of trying to regulate banks' involvements in this area, I'm not so sure I agree with that, but to take advantage of our position, to encourage or to raise awareness, to improve things like disclosure, I completely agree.
Per, would you like to respond to this?
Yeah, absolutely. I don't want to have my previous response misconstrued that I don't believe we need regulations in this space, right? Because I'm on your side here. I mean, that is what the Sustainable Banking Network was there to help support, right? Because we saw countries that had an urgent need to address issues, whether that was pollution, environmental, social risk in the mining sector, wherever it was coming from, right? And to see how do we address those risks and how do we address the issues of how a financial system manages those and how financing can flow properly. So further to Bill's points, right, we have now 12 countries that have now put in place regulations there. And I don't mean that this requires no tweaking Basel II, Basel III for capital requirements. We don't have the data there, right? This, further to your point, really goes more to the question around guidance on credit policies to manage these risks, but also the opportunities on the capital market side to define the standards and give clarity on those measurement, on kind of putting this out there. And I think what we have seen, and maybe, Michael, you may want to even comment on it, right? In the G20 Green Finance Study Group, right? The dynamic was very interesting, right? Because you had 5 members of the Sustainable Banking Network, which were far, far ahead when it came to the questions of regulations, right? And then you had now developed countries which were still grappling with the latest version of Basel to be implemented, right? And the dialogue and I think the dynamics were quite interesting. I see Raphael here in the room as well. I don't want to point anyone out, but I think there's a dynamic here. Just in the first 9 months of this year, right? We had over 8 countries join the Sustainable Banking Network because they think this is really top priority and they really have to work on this.
Thank you. Michael, you wanted to say something?
Yeah, just real briefly again, when the Bank of England did the review of the insurance industry and how well they were adapting to climate change, we went out and not only did we do some primary research with them, we went and did additional interviews. And as you might suspect, some of the insurance companies were extraordinarily on top of these things. I think Munich Re's had scientists working on climate change issues since the 70s, but others were meaningfully less engaged. So what it was, just by going through that and then going and talking to them once we had the results, was very powerful, because ultimately they started understanding, well, maybe our models, we bought our models for cat risk on a kind of a canned model, but the curves moved, so maybe we should start adjusting how our model works. So just going through and actually pulling that information together, speaking to the people that were responsible for regulating, actually turned out to be quite effective, and we found actually even some potential cross-current areas around flooding. If you think about that, well, the insurers think, well, fine, we'll just the policies are just 12 months, we'll turn it off. But at some point, it kills part of your business model. And also, by the way, if you're having more frequent and severe flooding in one area, you turn off your insurance. Then at some point, if there's no insurance, you first raise your prices, then the prices go up, then there's nobody who will offer it, then maybe the government has to step in. And oh, by the way, in the UK, you need to have flood insurance for your mortgages, and they're the longest pieces of credit that sit on a bank's balance sheet. So we started looking at, so just having those discussions with our firms was very powerful, and I think that's what you're speaking to, and that type of work has proved to be very effective for us.
Thank you. Yes, sir. My name is Nicholas Jost. I work I'm with the Luxembourg Ministry of Finance, and this is a topic that has been on my desk for some time. I've been studying engineering and now ended up in the government sector. And it's not the easiest customer, I think, to convey some messages when it comes to climate change. I worked on this file during the Luxembourg presidency, and this was on the run-up for the COP21, and the negotiations in European committees were not always straightforward. That said, on COP21, the issue of private finance is extremely important, I think, in particular in these times where the fiscal space of countries is very limited, so we have both challenges going on at the same time. So let me just focus on the issue of green bonds and make some brief advertisement, which I actually didn't know that Luxembourg, apparently, I was told, was the first country to emit a green bond on the stock exchange, and has a large share in global green bonds listing. And at the end of September, we launched, or the stock exchange launched the first platform for trading environmentally friendly securities, as I was told. We found that we identified that some shortfalls included the different definition and standards in this market as well. So this, I think, was mentioned, and to work on the standardization would help develop this matter further. One point I would like to agree with Madam Schulten is the issue of education. I had to work with colleagues at the Ministry of Environment, and I think that the misunderstandings on both sides are an impediment to constructive cooperation sometimes. The one does not know what the sensibilities of the other one is, and what I found on the side of Ministries of Finance is that the issue of climate finance, when it's put on the agenda, it's also the most likely agenda item that will be cut if there is no time. So it is quite frustrating to work on it, because we seem to be struggling sometimes with problems that are more short-term, that need greater attention, and this is not really a question, so I'm one of these annoying people that it's the first time I do it, so I figured it's fine. But my question would be, did this happen to you as well? And internally in your administrations or organizations, do you have the same feeling that people say, well, this is further down the line, so let's wait? And do you think that putting a price on carbon and monetization of costs and the calculation of net present values with discount rates and all that stuff could help show policymakers, well, the costs are coming, and even if they see that they are coming, would they care? I know this is very broad, but maybe you can pick out one or two issues.
Thanks a lot. What we'll do is let's take another couple of questions, and we can all answer them at the same time. You had a question.
My name is Soledad Núñez. I come from Bank of Spain, and I have a question related with securitization and incentives. There are experience already. I mean, in the past, I remember one from the Spanish Treasury some years ago, and another from the European investment banks that were more related with small and medium enterprises, with SMEs, and then you could create a fund, and the senior tranche has a guarantee from the Treasury. And in order to promote the funding of small and medium enterprises. And I think that here we can, it's possible to do something similar. Why? Because here we have to understand, I know that in general we are against the incentives and subsidies and things like that, but here we have to take into account that there are externalities and positive externalities, and then there is some kind of justification for that. And then this kind of securitization funds that has to be very simple. You just impose a condition that in the asset side of the fund you have to have a proportion of environmental friendly bonds, and the funds raised has to be to finance projects environmental friendly. Not 100%, because otherwise it's difficult to work, but in a high percentage. The only problem with this kind of initiative that I think that for the Spanish Treasury it worked, and the promoter was a colleague of you, it was Mr. Caruana. The major problem with this kind of initiative is to control it afterwards. I mean, you need efforts. I mean, you need resources in order to check that the bank is doing it properly. No, and I think it's the biggest problem. And also, if you belong to a treasury with a low rating, and then you don't get a lot. No, but this could be also used by kind of a more international organization, like, for instance, it was by the European Investment Bank.
Thank you. One last one. Oh, I got to pick. This is a challenge. Who went up first? There you are. Yep.
I have two direct questions, which hopefully be brief. First, Mr. Sharon, would you please describe the structure, covenants, terms, and economics of the Berlin bonds you mentioned, and what made them a special value? And for Mr. Stein, what assistance is IFC providing to private developers in the form of fast-tracking or co-negotiating green projects to perhaps circumvent a 2 or 3 year negotiation project with a host nation, for example? Are you providing first loss capital, and what other incentives might you be providing? Perhaps you can only support P3s, for example, but those are available. Thank you.
Thank you very much. What we'll do is we'll start from you, Ashley, and we'll go down this way. If you could take the two questions which were raised earlier, the lonely struggle of the climate folks, that was one, and the other was if you can regulation help internalize the positive externalities from this, and also to what extent can supervision compensate for any issues that might arise, and then those two specific questions. Ashley, can we start with you?
So I'll say to the gentleman from Luxembourg, first of all, thank you for your Luxembourg listing, because we have been asking for some sort of formal list of, approved green bonds for a while. We have our own list of what we think are true labeled green bonds, but there isn't an industry standard of a list out there currently. And I'm on the executive committee of the Green Bond Principles at ICMA, and I have been encouraging ICMA to provide a list, because in the absence of some sort of collective body issuing one, people will come up with their own lists. There are a couple bond indices that are out there now. Two of them actually reference Climate Bonds Initiative for their list. And while I have lots of respect for Climate Bonds Initiative, that is an NGO. And I really don't want a small NGO really providing lists that we're going to manage big mainstream pools of money off of. So list of bonds that conform to, even though they're voluntary guidelines now, I find that extremely helpful. And then to your point about the attitude of coworkers. So my administration is the trading floor, and 4 years ago, for sure, especially in the U.S., some people I think view this as a political issue. Whether you're a Republican or a Democrat, and there is some sensitivity around it about climate risk in general, and also ESG integration. And so there was definitely a sense that. That this, looking at ESG issues was somebody else's job. That was the job of the corporate governance group. That was not a risk that was going to manifest itself in my P&L, and so I was going to set it aside. And I think that the UNPRI has done a really good job over the last 2 years, really pressing on asset owners to sort of really demonstrate how they're incorporating ESG factors. And what that has turned into is then the asset owners pressing the asset managers to really, tell us exactly what you're doing on the ESG frontier. And so I think that, while there was definitely pushback, that the tone of that conversation has changed in the last 6 months. And I think it's because, for me personally, my portfolio manager hearing from their asset owners, in meetings, tell us about the climate risk in their portfolios. And when the asset owners, the clients, are asking about it, then the asset managers really have to be able to talk about it and defend it. So that's one thing. And then just there's the conversation after COP21 in terms of public interest in this conversation has really picked up so dramatically that you have very senior members of my firm engaged in this dialogue in a public manner, and that has spurred a lot more interest in the space.
Bill?
I'll be brief. I just would like to respond to our friend from Banco de España. When it comes to providing incentive, I just think it's a really inefficient way to do it through regulation. There are tax incentives. Government can guarantee a first loss piece of a securitization or provide other guarantees. That's more direct, and the chances of spurring that kind of investment are greater than doing it, for example, and use the example, pardon me, of preferential risk weights for small and medium-sized enterprises, the SMEs. Just because there is this preferential risk weight doesn't mean that banks are going to lend. In fact, I think that's part of the problem now. There's the level of lending. There are lots of good projects out there, but banks' willingness to lend, either they're constrained because of capital reasons or for other reasons. So there's no guarantee that you're going to encourage this kind of lending through capital regulation. So I think that's I think that's part of the problem. There's also a longer-term problem. Capital adequacy should be risk sensitive. So the amount of capital a bank holds for unexpected losses should be commensurate with the risk. On SMEs, we actually have lots of data that show, as an asset class, there's an above average level of risk. What happens longer term if banks were really to lend a tremendous amount to a certain asset class because of capital regulation, but in reality, the risk of loss is greater over the long term. So from a financial stability, from a prudential perspective, that's undesirable. Anyway, thanks.
Yeah, just 2 quick points. One, to address your question of how we finance private developers. So in green projects, so it's a clear stated priority for IFC to ramp up our financing for private sector projects in the green economy. We have set ourselves a target of reaching 28% of our commitments in the space. And we are also making efforts to move markets to be faster in financing them. So we have the initiative Scaling Solar, which is about PPP solar projects, which should get our solar projects out from start to award in 12 to 18 months. And then obviously with another 12 months to realization. So that's clearly one of our priorities for the corporation. On your point about regulation and the question of ministries not understanding each other, I think this is a key topic for us to really make progress. We believe that the INDCs, which have been put forward at COP21, hold really great promise, but only if you really get coordination across all of the ministries that are involved with the right political leadership to translate them into policies that you can then plan and work with, right? I mean, because if you have some sense of planning horizons, of priorities that are being set at a political level, that may address phasing out fossil fuel subsidies, putting prices on carbon and other policy measures that I think can really create markets, I think that would really make a big difference to then also align the financial sector and instruments that can finance the green economy.
Thank you.
Yep. And very quickly, I must say, I don't recall if it's Berliner Bank. It was a German mortgage bank. So basically, what they do is a covered bond off their balance sheet. All of it was commercial. What they did is obviously they provide the financing based on the information provided. One of the interesting things that they hadn't done, but they were going to work on, is try and get an understanding of, based on the efficiency of the build, how much carbon that was actually going to save via traditional building. So they were going to try and start quantifying the level of carbon saved on it. But the interesting thing about it is, and I must admit, I don't recall the exact tenor pricing, but I can certainly provide that for you. I actually even know the name of the banker. I know JPM underwrote it. I think Goldman's was on it as well. But if you drop me an email, I can get you in contact with the people. You can get to take a look at the actual offering memorandum. You might be able to talk to Ashley and see if you can find some on the secondary market.
Well, thank you very much. I'm now going to close the session. First, make a quick few remarks just to close it. First of all, a lot of thanks to Toronto Centre for hosting this, for holding this event, and particularly to Babak and Demet, wherever they are. I see at least Babak out there. So thanks a lot. For those of you who were unable to ask your questions, I encourage you to catch hold of the speakers before they leave the building, but that's on you. A quick summary of what I took away from this is We all agreed that it's important to continue to push the agenda for green finance. I think there was a lot of stress also on continuing with the efforts to develop the green bond market in particular. We did all agree that disclosure is a very important part of the discourse to drive the policy agenda ahead, as well as the regulatory initiatives which might be better served by better disclosure. On the issue of whether or not regulation should provide positive incentives, it was clear that while, as Bill said, that while the framework should be supportive, it could not substitute for financial stability. It couldn't take on the risk of allocating these risks by diktat, and instead it would let the it would be better these were better served by more direct interventions, including by, if possible, as you mentioned, government taking or government subsidies or government or public sector subsidies or other market development which might substitute for these efforts, but not regulation. Although he did agree that it was important to provide a supportive framework in terms of better understanding these issues, better encouraging the discussion and debate, getting more information from their peers and putting it out in the public domain. With this, I would also like to sort of summarize in another dimension the four topics which, or the four dimensions which Ashley raised, which I thought were a very good way of pinning this discourse. They're about education, about digestibility, about consistency, and motivation. And that's probably a good way of looking at the discussions going ahead. Finally, to close, to make another pitch for an event which is following, I think, very shortly afterwards, but not here, and that's in the Ronald Reagan Center, where the UNEP report is going to be launched, which talks about better aligning the financial systems of tomorrow with the new environmental realities, and I think my fellow panelists, some of them are going to be there at that discussion also. Thank you again for being here. And thank you to my panelists. I forgot that.